So once again, welcome everyone to week 2. Tonight we will be covering chapter 2 of the class, and chapter 2 is on estimating hazard risk. And basically tonight's class, as I mentioned, at least in the email, is this is really a foundational element of understanding risk finance. And when we talk about estimating hazard risk, we're essentially doing what an actuary does. And so if anything else, this should give you a glimpse into the crystal ball that they use and how they determine what the rate should be, or if nothing else, your risk manager. Why do you choose a certain deductible over another one? When you think about your homeowner's insurance or your auto insurance, it's pretty easy. You pretty much have a choice of $250, $500, maybe $1,000 deductible. But when we get into workers' comp, now you're dealing with issues of maybe, if you're a small organization, a $5,000 deductible, to a large organization like University of California, in which we have a $5 million self-insured retention. And so we'll talk about really how much retained risk, and this is what tonight's class will really be focusing on as we go forward through the rest of this. Since as I'm doing the class, I'm not going to be actually, at least for this one, because of travel, I'm not in person with other students that are with me. So obviously you'll probably have to type in questions or ask questions by raising your hand, and we'll see if we can address those for everyone as well. Tonight's class also most likely will go past the standard 90 minutes because there's quite a bit of information to cover tonight. So I want to make sure we do cover it so that everyone does understand as best as possible. So going on to the objectives, even though there's only 4 objectives, this is a relatively long chapter. And so the 4 objectives on each one of these is be able to explain how to analyze and evaluate hazard risk. This can be the first objective. The next one is how to estimate expected losses arising from hazard risk. Be able to explain how to apply the increased limit factors to hazard loss estimates. And finally, explain how to estimate the volatility of hazard losses. Now, even though it says explain, usually a lot of times when it says calculate, so you're not necessarily going to have to do the calculations as much as be able to, when you're given a table, as we go through tonight and you see some of the tables, you're going to have to be able to explain what those tables are essentially talking about. So as we do like a loss development triangle and discuss what that is, you're going to have to be able to explain what that is and why that's important. So even though calculations may not be the key part of this, there might be some simple calculations you might have to do, and you have to understand and be able to explain how to basically do some of those calculations. So when we talk about analyzing and evaluating hazard risk, we're typically, in most cases, we're talking about quantitative data versus the qualitative. So as we go through the first element, quantitative, that's easy, that's numbers, it's objective, and typically it's data from past losses. The other element, which is the first bullet, is that hazard risk, when we're looking at analyzing hazard risk, we're talking about pure risk. So we're really talking about things that are insurable in this case. And so as hazard risk, by definition, it can either result in a loss or no loss. So if you think a kind of binary, it's either a 1 or a 0 when we look at these things. So when we talk about quantitative, what type of data are we looking at? Typically, we're going to be looking at internal records. So either our own loss data that we would have based upon managing our own claims, or I should say, it might be insurance data. And why the or is in there, or and is in there, I should say, is that we might retain a certain amount of losses, but certain things might get transferred to the insurance company for excess, and so we might have to take a look at their numbers and what they have for us. And really when we're doing quantitative analysis, we're really talking about regression analysis. And if you think about what regression analysis is, even though it scares most people when they hear that term and think of statistics, regression analysis is really looking at, assuming that all things stay the same, what can we predict in the future? We're looking at trends and what the trend line would be, assuming that our losses are basically going to trend the same way based upon our exposure data. And as we go through tonight, one of the things you're going to see is that, let's say you have, I'll use the Bureau of Labor Statistics numbers. If we say we're going to have 3 injuries for every 100 full-time employees, and we only have 100 employees, we expect to have 3 injuries. But if we have 200 employees, now, based upon that, using that calculations, if we were going to have 3 injuries for every 100, if we have 200 employees, we should probably expect to have 6 injuries. And that's all that we're doing, is we're developing a trend line based upon historical data to basically map out a possible future. And as you'll see as we go through tonight, how we do that, and some of the probabilities that go based upon some of the ranges or buckets that we talk about. Now, when we look at data, one of the main concerns we have is that we may have too few a number of loss exposure units. So in workers' comp or auto, usually there's enough data points to have claims to be able to do an analysis. But for general liability claims, depending on the type of organization, you may only have 2 or 3 claims or even 10 claims. And that's really not enough data to do a true loss, hazard analysis to evaluate future claims. And that's also the case if you think about terrorism insurance or other type of exposures that don't happen that often. That can be part of the challenge as we move forward there. Now, and we do have, it looks like the hand went down there. So the other issue that we have, and we'll talk about this more, is too short a time period over which data is collected. And I put the term green. So the idea is if we collect data, and it's workers' comp data, for example, and we end at the end of the calendar year, and if I want to try to, using that data is probably not a good idea because the claims in that are going to probably grow. They're not mature enough. And so as we go through tonight, you're going to hear me talk about loss development. So typically, if you have a claim that costs, let's say, $1,000, the rule of thumb is you triple it. Most likely that by the time that claim closes, it's going to cost $3,000. If I use that data as it being very early in the claim period, most likely it's going to be too green. It's not going to yield accurate data for me to be able to do future projections. And the third item when we look at data is lack of diversification of operations. If we're not diversified, or depending on if we have one basic exposure and then we change our operation to do something differently, we can't necessarily use that data to project injury rates or other type of claims because we've changed our operations at that time point. So that's what I mean by diversification of operations, is you want to have a diverse set, so it's kind of the law of large numbers when we start looking at these type of things. Which obviously goes to the next slide, is the law of large numbers is really the key to this. The more data we have that's credible, accurate, consistent, then the law of large numbers will apply, and that's why regression analysis really then becomes a better predictor. If we don't have as many data points, it's not going to be as accurate for us to be able to move forward on. And looks like we do have Herb, you have a question? I'll go ahead and unmute your line. Herb, can you hear me? Looks like, Herb, your line's not working there. Okay. So we'll go back to the presentation here. So on the flip side, we talk about qualitative analysis, and you kind of think, well, how can we do something qualitative when we're talking about loss data? And on qualitative, it is going to be subjective, and it's data used to estimate losses that draws upon education, training, expertise of practitioners to estimate probabilities that certain losses will occur. And then the different ways we can do that: scenario analysis and failure mode effects analysis. Qualitative analysis is typically used in where we don't have a lot of data to use. And so we can think of, okay, earthquakes. What's the likelihood of an earthquake? What kind of damage would an earthquake cause, at least in California? Or some other event, wildfires. Or one of the events that we take a look at, library collections for universities, is what's the likelihood of a major fire in a library? Well, there's not a whole lot of data sets for us to draw upon, but we can determine based upon what's the value of the building, the value of the books that are in there, is the building sprinklered, what kind of damage. We can probably come up with some estimate of what we think the damage might be, or the possibility or probability of losses would be. And so that's where qualitative analysis really comes into play, is when we don't have any data, we have to make some estimates, because at some point you still have to be able to draw some conclusions about estimating the hazard risk. When we look at hazard risk from an evaluation, ISO, International Standards Organization, defines level of risk as the magnitude of a risk or combination of consequences and their likelihood. And the level of risk is used to determine the amount of hazard risk to retain based upon an organization's risk criteria. So basically what that's saying is when you think about the level of risk of what's the possibility, or the combination of consequences. So what's the possibility of having an auto loss? Well, you can have an auto loss because of theft, the car getting hit. You can have certain things that may potentially cause property damage or property damage to the vehicle. And there's different situations, the combinations and the likelihood of those events occurring. Now, if you think about it again from an auto standpoint, if you notice when you do auto insurance, at least in California, they're always asking about your zip code. One of the things they're able to determine is based upon either where you live or where the vehicle is garaged. They have data on theft of vehicles. How often does a certain type of vehicle get stolen, or what's the rate of auto accidents in a certain area? So like in Sacramento or Oakland or LA, for example, they have a better idea to be able to make estimates and to use that as part of their calculations to determine what they should charge you for premium. And so that's really when we talk about hazard risk level. We talk about retained hazard risk should be made in the context of other type of risk. So what that basically means is that when we consider, if we're going to have a high deductible or a high retention level, let's say we want to have $10,000. If we go from $10,000 of self-insured retention, meaning we're going to pay the first $10,000 of each claim. That might make sense because it allows us to take a couple hits and we only have to pay $10,000 out. But if I decide to take $1 million self-insured retention and we're not making that much money, one hit could basically put, from an operational standpoint, can put the organization out of business. And so that's why when it talks about the context of other types of risk is do you have the financial ability to pay for claims? And so we got to look at what's the possibility of some certain types of losses and what's the appropriate amount of insurance or retention of risk we should take on. And also the level of hazard risk to retain also depends on the cost of insurance premiums. So ultimately the objective is for any organization is to retain as much risk as possible. So if you can self-insure to the hilt for your organization, that's really what you will want to do. But there's certain things that may make it not affordable. So when people hear or talk about a hard and soft market, basically a hard market means that the insurance companies can really charge whatever they want because the availability of reinsurance or other things is very limited. So if you think of supply and demand, in a hard market you're going to pay much higher prices, whereas in a soft market, essentially you're going to, because there's a lot more competition, rates are going to be lower. And so in a soft market, it may be more, because rates are lower, you may want to go ahead and buy a lower dollar amount because it's more affordable. But in a hard market, it may make more sense to retain risk because the premiums will be much higher in a hard market. And also the idea that, and the way to think of this is there's really no bad risk, there's only bad premiums, as my old boss used to say. The idea is that you can pretty much insure everything. The issue is what are you going to pay for it? So when you think about insurance and buying insurance or how much you're going to retain, that's all part of this equation of what's the market, what's available, what is it going to cost, and that's why this hazard risk evaluation is really so important and to the core of really what every organization needs to be able to do when they evaluate that. So when we look at estimating hazard risk, there's a 4-step process, and again, from a testing standpoint, whenever there's things put in a list, and especially when they're put 1, 2, 3, 4, it's something that you want to make sure you mark, because most likely it'll be on the exam. So steps in estimating hazard losses, we talk about it, and when we talk about hazard losses, we're talking about dollar amounts. So a lot of times you think hazard losses, what does that mean? We're talking dollars. It entails calculating an estimate of the expected, and when we talk about expected, that's the average. So in statistics, expected is the mean or the average. Losses for the coming year based upon past data, and it requires an organization's risk management professional to complete the 4 steps. And so the first one is we're going to collect data and organize past data. And how we do that, we'll kind of go step by step through these things. But we need to make sure that we have past data, past workers' comp loss analysis data we're going to take a look at, or if it's general liability or auto. The next step is we're going to talk about limited individual losses. And we'll go in more detail on this as well, but when we talk about limiting, if we have, most of our claims average $10,000 and we have one claim that's $500,000, that's going to skew our data unless we limit it. So there's some value in kind of putting, limiting, because otherwise we include outliers which may not be a true representation of how our claims are. And then we're going to apply trend and loss development factors to the data. And finally, we're going to, based upon that, we can now forecast our losses. And we can do that essentially using our exposure data to extrapolate what we predict in the future. And then again, the representation, if anything, nothing else, I would just, the graphic that's at the bottom that shows the 4 steps, if you can explain that, and then, as we talk through the rest of more specifically, you'll be able to basically understand the concept and answer the questions on the exam related to this. And we talk about collecting, organizing data. It's important to understand what the kind of the fields are that you may see in loss data that your third-party administrator or insurance company may provide. First of all, paid losses, or losses that have been paid to or on behalf of the insureds during a given period. So you're going to have one bucket that says this is what we paid for the claims, and then you're also going to have loss reserves. And so if let's assume that someone had a back injury, well, and they've gone to the doctor. Well, at this point, the paid losses, let's say, are the doctor's visit, and let's say it's $150. Now, the loss reserves, based upon the information that I have, the third-party administrator or the insurance company, let's say, is going to reserve, they feel the total claim is going to cost $1,000. So we're already paid $150, and the other amount, the loss reserves, then will be $850. So that becomes, at the bottom where it talks about our incurred losses, is the sum of paid losses, loss reserves, and we'll talk about loss adjustment expenses here in a moment. And so when we talk about incurred losses at the bottom, the way to think about it, just put the word total incurred losses, because that includes everything. Loss adjustment expense reserves. And there's loss adjustment expense reserves and paid. When we think about this, you might see that, but the way they've had it in the book is loss adjustment expense reserves. And the idea behind that is that if there's a claim and it gets litigated, well, that's the cost of hiring the attorney. It can also be the TPA cost of what they think, or having an expert witness as part of that. It might be, but it's, when it talks about loss adjustment, it's the idea of as an adjuster is going to have to manage and handle that claim. It's what they're expecting those costs are to actually manage and adjust the claim are part of that, and they'll put that into the reserve bucket. So if you look at the bottom of the page here, and it talks about, so incurred losses will equal, so I for your own benefit, I'd probably put the word total in front of it. So total incurred losses will equal the paid losses, so that's what we paid out, medical bills or lost time for wage replacement. That'll be part of that paid losses. The loss reserves are those things that we expect to have to pay in the future. If the person's going to be out of work for 10 weeks, loss reserves, we're going to put money set aside there to pay for those. And then finally, the loss adjustment expenses are going to be those such as attorney fees and things like that. Now, when we collect and organize the data, there's a couple of things that we also have to keep in mind when we start evaluating. So we have the claim data, we have our loss reserves. The time frame in which we collect the data is really vital. And as it says, it's necessary to collect loss data from previous accident years because an organization's paid losses and loss reserves change over time. So the time period typically in which we're going to collect the data for each individual year is going to be 12 months. And so we're going to take, whether it's a calendar year or fiscal year for the organization, that's the time frame in which you want to collect the data. And so you can compare apples to apples or years to years when you're certainly doing that. You also have to keep in mind what's called loss development and payout pattern. And that's an analysis of the previous evaluation to track past loss development and loss payout patterns. So an example is work comp claim will probably take 6 to 7 years if it's a large claim to basically from start to finish to close out. And so the loss payout pattern or loss development of how quickly does the claim increase from what we predict it to be. So if we originally reserve a claim at $1,000, but by the time it closes is $3,000, how quickly does that claim kind of grow or mature, as we'd like to say? And then also, how quickly do we actually pay out those claims? So are we going to pay $2,000 out in the first year and then $500 in the second, $500 in the third? that might be the payout pattern. For general liability and auto, typically the payout patterns are within the first 2 years, and a lot of times the claims will close within the first 2 years, whereas workers' comp will take probably 6 to 7, environmental claims may take over 10 years. And so the payout patterns are important as we go through as we look at this later on. And then finally, large claims. And large claims are somewhat of a relative term depending on the organization. And so in this case, such as those over 100,000, an organization's risk management professional should obtain specific information on the cause and circumstance of loss so that loss control techniques can help mitigate similar future losses and also determine whether it's an anomaly. So if there was a claim where you had $1 million claim and everything else was $100,000 on average, there's something different about that. You want to find out what's going on to find out does the circumstances or the basis for a claim to happen like that again, do they still exist? And so you can certainly correct those, or was it just an anomaly in which you can cap that specific claim and you're really not going to have to worry about it again, or maybe you closed out a certain type of operation led to it, and in that way it helps you from prediction when you start looking at what your future losses might be for that. Also in general, as loss payments are made during the accident year, paid losses increase and reserves decrease equally. So the example using $1,000 is the total incurred cost, and we said $150 is what I paid, and I had $850 was my reserve. Well, if I paid another, let's say, $350 on that claim, now my paid losses are $500 and my reserves are $500, and our total amount is still $1,000. So typically it'll remain the same. Now, but you got to keep in mind they do change when a reserve is amended because of new information that comes in, or what they call additional information. So where you might have someone that sprained their back and the claim was initially reserved at $1,000, if it's later determined they did something much more than that and they require back surgery, they might have reserved at $1,000, but eventually the adjuster will say, now this claim is worth $50,000, and that's when you get a change which changes both the reserve and the total incurred amount. And that's something to keep in mind when you look at, and it happens more often than you might think, that most claims, the reserves do change over time. And this is somewhat of a side note, but the concern when you have a third-party administrator is what they call stair-stepping the reserves, is that based upon the information they have at the time, are they reserving conservatively, or are they really reserving what they predict as ultimate loss? And if they stair-step, you may not be getting an accurate picture of what those true reserves or what the total incurred amount is, and then you may have not enough money to pay for those in the future there. So we do have a question. So Mustafa, I'll go ahead and unmute your line. Mustafa? Oh, looks like you lowered your hand. If you want to go ahead and do it, just go ahead and raise your hand again, Mustafa. Your hand went down, and I'll answer your question there. All right. Looks like I know sometimes people end up accidentally raising their hands, but if you do, I'll go ahead and unmute your line so that we can hear your question. So the other accident year's account will be kept open until all losses for that year are paid. So when you think about it from an actuarial standpoint or just from an accounting period, if you have claims from, and this is 2013, and we have claims from 2012, 2011, all those claims technically will stay open, or as long as those claims are open, we're going to keep, we're going to account for those losses, and we're not going to put the, as we call, close out that year until all claims are paid. And a lot of times what happens, you might only have one claim that's still in a prior year, but as long as that claim's open, the actuary needs to make those determinations and still account for future claims total incurred and do calculations based upon that. Now, when we talk about exposure data, this is important because right up to this point, we've really talked about, actual losses. Now, exposure data is, as it describes, as a fundamental measure of the loss exposure assumed by an insurer. So typically for workers' comp, it's going to be the number of claims per hour, or injuries, injury frequency rate, or claims per FTE, or if we're dealing with general liability in a restaurant or other area, it might be the claims per square footage or transaction, or the number of claims per vehicle if we're talking auto. So an exposure data is a base, or sales, as we'll talk about later. It can be a determination for us to make future calculations. The idea that if we expect to have one claim for every $100,000 in sales, and it costs us $20,000, we know if we make $200,000, we expect two claims and to have certain things. So that's where the sales data becomes important, because it becomes a predictor and able to project future types of claims. Now, as we talk about loss development, so loss development is an increase or decrease of an incurred loss over time. Most cases, the rule of thumb, loss development, if you have a claim that's worth $1,000, at least workers' comp, loss development factor, you're going to have a number that you're going to multiply it by, then the actuary can predict based upon past losses. So for the University of California, historically, our loss development factor at this point is 2.71. So if we were to have a claim that's worth $1,000 at this point, we would multiply by 2.71, and essentially that claim, most likely by the time it ends, based upon past experience, will probably close around $2,700. So that kind of gives you an idea how that would work. The loss payout pattern is what we've mentioned before. It's how things are paid out, how quickly. Workers' comp will pay out over a longer period of time, and most money happens in the first 2 to 3 years, and then we have a much slower payout period in the last 5, 6, and 7 years. And then also the valued as of dates. This is really key, especially for EH&S professionals that don't see loss data that often. When actuaries get data, they typically request data, typically at 18-month development periods, and then 30 months, and then another 12, and they basically go 12-month periods after that. So most of the time they don't do valued as of dates at the end of 12 months, because the most recent claims are still very green, and so they wait at least another 6 months. So when they do comparisons of data, they request data at certain timestamps so they can compare each year to year to make sure that, again, comparing apples to apples when they look at that. And that's also very important when we do talk about loss development triangles here in the future. The second step is limit individual losses. So when we talk about limiting individual losses, why do we want to do it? So limit losses to match the area being forecast. It will help stabilize losses so they don't vary from the year to year when analyzing. And usually that's done with what the deductible is, or what your self-insured retention level will be, is usually what those claims are capped at, because that's what you're going to ultimately be paying. And also it's the whole issue of outliers, and that's why limiting is important. And the losses are typically more frequent at lower loss levels. So I think most of us would realize that having a $1 million claim doesn't happen as often. We're probably having a $5,000 or $10,000 claim is probably more likely to occur, and so we can limit claims at maybe a $50,000 level, or whatever another level the actuary determines. But we wouldn't want to limit to $1 million, because now we don't get that variation. It's still going to skew our results. And then one of the other things we have to understand is increased limit factor tables. Now, you're not going to have to calculate these. These will be provided, but these are tables used by insurers to price layers of coverage in excess of insurance-based limit. So basically what that means is they can say, okay, based upon past experience, we see these type of claims. If you're going to buy coverage and we're going to insure up to $50,000, it's going to cost this much, but if you want from $50,000 to $100,000, it's going to cost a little bit more. So the question is, does limit mean up to the deductible and insure above the limit? So when we talk about in excess of the insurers-based limit, I mean, it's a self-insured retention level. So when we talk about, so the base limit in this case would be the floor. So if we're talking about that we're going to insure up to a $50,000 limit, so that means 0 to 50,000, that would be the limit. So I believe I'd say yes based upon the question, does the limit mean up to the deductible? It does mean up to the deductible. It really means the same thing. It's up to the limit of what the insurer is basically requesting in that case. And these data tables are basically developed by actuaries, and they're used industry-wide data, so they have much of the law of large numbers to back them up when they do these increased limit factor tables as part of that. So some of the exhibits as we go through the book, this is to help explain what this means. So in this case, in this exhibit, they're showing that general liability loss data is limited to $50,000 for this organization. It's called Tartan, and it shows the various years in which we have it. So if you look at it, you see 21,000 as a loss we had during the first year, and Up to this point, everything seems pretty good, and then you see we have $50,000, but the loss was $200,000. What this basically means is that the total loss occurred. We had a $200,000 loss, but loss limit, our self-insured retention level, is the organization was only responsible up to $50,000, meaning the insurance company they paid that balance between the $50,000 and the $150,000 level. So that's basically when we talk about limit factors, this is kind of the area, and we'll talk more about the tables here in a moment. It's the limit factor tables. So I know some said it may not have been clear, and I think when we show the tables, it'll be much more clear here. So if you look at this, the total in 2001 was $289,000 is what we total losses, but we actually only had to pay out $139,000 of our own money because $150,000 was paid out by the insurance company. So we still want to account for those losses because those are true losses. And the reason why we want to do that is if we decide we want to self-insure, we need to make sure we have the full loss picture, not just those capped. And that's why we're looking at the full loss data on here, the total loss amount. So again, here in 2002, you see 1.2 million, but our limit is 50,000. We're capping that because that was an anomaly. And you can kind of go down, you can see how that basically works through all these different years as we go through here. When we look at it from a graphing standpoint, so this helps demonstrate the stability of claims by capping those claims. So this is the $0 to $50,000 level. When we cap the claims at $50,000 based upon what our retention or our loss limit is, you can see it's a fairly very stable, consistent line or trend. You can see that in 2002 is when we had that big claim, and we can see how it kind of had a blip there. Now, this table down here is showing the $50,000 to $1 million layer, meaning that these are all the things, and you can see how things even above $50,000 are fairly stable, but then we have this one large loss claim which becomes an outlier, and that's really where catastrophic insurance would come into play. And so one of the questions we're going to be asked as we go through this chapter tonight is, does it make sense to have a $50,000 deductible? Would we want to go up to $1 million? Would it make sense for a company to go to $1 million self-insured retention? And that's part of, as we kind of build up through this chapter tonight, you're going to see how we go through that. So step 3, we're going to apply loss development and trend factors to the data. So what are trend factors? Those are basically percentages that are applied to current dollar amounts that restate dollar amounts for a forecasted year, whether it be inflation or regulatory changes. So when we talk about trend factors, I would probably say it's more likely inflation. We're going to be putting those dollars into net present value, and so that we can compare apples to apples when we talk about inflation issues as we go there. And the question was of the exhibits from a previous version of the book, and actually I believe I did actually use some of those from the previous version, at least in this one. So, but I think they'll still make sense as we go through here. The loss development factors, as we mentioned, are percentages applied to aggregate past losses for each year. And we'll see this is that basically a loss development factor, I mentioned, for university it's 2.71. And the idea is that whatever we end the year in at 12 months, if we multiply that factor, that's going to be our loss development factor. Then our ultimate loss development factor is the numeric factor that is applied to the most recent estimate incurred for a specific accident year. And so actually I should back up here, I misstated. So 2.71 is our ultimate loss development factor because that's based upon to the most recent estimate. That's what we have. You're going to have loss development factors for each individual year as well, and you'll see that in a minute of how those loss development factors basically play in there. So here's a loss development factors for general liability. As I mentioned, here's your policy year, it's 18 months. So, and then every 12 months after that, so there's 18 plus 12 is 30, and you go through, so you have being 18 months each additional year after that. For bodily injury, the ultimate, in this case, development factor would be the most recent year which we apply. So 3.75 based upon a bodily injury claim, if it was $10,000, we multiply that by 3.75, and that would be the estimate of what that claim is expected to cost, approximately $37,000. If it's a product liability claim, our ultimate is 4.52. And then these other ones are still loss development factors, but it's based upon if we have better data at 54 months, our factor we multiply is 1.3, and that will get us to our ultimate factor of what we expect our losses to be by the time the claim completely closes. So basically, that's all these factors are doing, and what actuaries do every year when they look at the data, they say the most green year we're going to apply this development factor, and then we have data that's now 30 months old, we're going to apply the 2.10, and now we have other data. And they have loss development factors based upon past experience of that specific organization. And so this is not something you're going to have to calculate, but if you have loss development factors, those are something that will be calculated for you or provided to you to be able to make that determination. So again, why is loss development, why is it important? And this is really one of the key concepts you need to understand for the exam, is that really claims are dynamic and loss data does change. Usually we end the year for the university around $21, $22 million in workers' comp. By the time everything's said and done, those claims are probably going to close at close to about $42 to $45 million. So that as data changes, and the more mature as it indicates, they're less subject to development as part of that. Also, as far as the slides, you should have all these slides as part of the for the class tonight. So hopefully I didn't choose the wrong slide deck here, but someone is asking if you have those slides. These slides were sent out earlier today, and you should have these slides as well. If not, they're available on the ARM study group website. Then the other issue is different coverages have different loss development factors. As it just showed in the previous slide, bodily injury, property damage might have some, work comp. They all have some different loss development factors as part of the structure here. And also, loss development factors are used to estimate development of an entire group of losses. So typically, we're not going to say we're going to apply to this one claim and say, okay, this claim is 10,000, now it's going to be worth 30,000. But when we take it as the law of large numbers in aggregate, that's really where we use the loss development factors, because each claim is going to be a little different, but when we have them in aggregate, that will certainly help us. And loss development, as it says, typically only affects open claims. And the reason why typically is in there, as long as a claim is open, it can still develop. There are certain cases where a claim would close, but then it might reopen because of some circumstance to where then there's more money based upon the laws, and that's why the word typically is in there. But loss development typically only occurs when the claim is still open, and they can be calculated from an organization's own losses if sufficient number of past losses exist. And that's why it's important to have enough data. If there's not enough data, then an actuary or someone else use loss development factors based upon a typical organization that might be part of that. So the question received here is, are there aggregate loss development factors that cross all coverage types? To be honest, I'm not sure about that, but what I would probably say is typically the loss development factors are going to be specific to workers' comp, EPL, and so it's going to be based upon, so when we use our work comp data, we have a specific loss development factor for work comp, and we'll have one for general liability and auto, so they usually don't cross. There's not an aggregate typically for that. It'd be just because the way an organization might be set up can be quite diverse. So typically you're probably not going to see cross coverage types when we look at those type of things. So here is what's called a loss development triangle, and this really shows loss development on here. And this is actually typically used by most actuaries. They'll produce a loss development triangle. If you get an actuarial study, you'll see something like this in the study. Another question is, are these factors fixed? All bodily injury is 3.75. So when we say fixed, it changes every year. So the question, if we go back to the previous slide about loss development factors and actually this, so 3.75 will be the case based upon our past experience. The actuaries will revisit this based upon new data as it comes in. It'll probably stay pretty close to the same if our regression analysis or past claims are the same. So maybe it'll go to 3.7 or might go to 3.8, but typically it's not going to drop down to like 2.0. So it is relatively stable as long as the claims continue to develop how they have in the past. Now, where things might change, and this is actually a good example from an exam question we might get, what would cause a loss development factor to increase for some reason? Well, it could be a change in legislation. So let's say workers' comp. So if we have workers' comp, there's new legislation where the payout, instead of getting $800 per week, they get $1,000 per week. Well, that's ultimately going to change how much is going to be paid to an injured employee. And so that will ultimately affect, most likely, the loss development factor. So legislation, those type of things, or inflation could certainly have an impact on loss development factors. But again, it's based upon regression analysis and how those are determined, and then the actuaries will put some parts in there. Going back to the other the loss development triangle here, and the question, someone did ask a question, are loss development triangle actuals or development factors applied to numbers in the table? So in the case of loss development, this is actually how you get the loss development factors. And so these are actual numbers. So if you look at 2001, a claim was originally, we ended at 18 months, and the total value of those losses were $63,551. 12 months later, that same set of claims is now worth $100,000. And essentially, by the time I would say, kind of almost close out, 5.5 years later, we're at $139,000. So you can kind of see how this number almost doubled in this case. And you can see the same thing here. 72,000 doubled to 158,000, 71 to 141. So you can see that ultimately, at 18 months, 63,072. When most people get data, let's say I was looking at, if I didn't have it valued as of, and I was looking at data, you can see more of a line going this direction. I'd see 2001 was worth $100,000 and 2002 was $72,000, and that's the way I would typically see the data if I wasn't asking for valued as of dates. This allows us, if you look at this last line here, we can now compare apples to apples, or at least this way: 63,000, 72,000, 71, 7370. This is the value at the end of 18 months for each of these years. But what we can do here is, if we were to calculate this period from this period and then average them, we would come up with a loss development factor that's specific to these claims. They're limited to the $50,000 rate. You're not going to be asked to do this on the exam, but the idea is to give you an example of how loss development factors would basically be calculated, and it's using this loss development triangle of looking at each year on these set dates and then making a determination of how do these type of claims grow over a period of time. So now let's look at loss. So if you look at this, so this is actually, so the question is where the factors come from. Well, we can basically take a look at how these claims. So if you look at this right here, from the previous slide that shows the dollar amounts, this is the idea of now we're looking period to period and what these loss development factors are. So from 18 to 30 months, it was 1.58. So if you were to do this, divided by this, you come up with a factor of 1.58. That's where these numbers are coming from. From 31 to 42, the loss development factor is 1.2. And then essentially from 55 to 66 months, it's only about a 3% change. So, 54 months to ultimate, you can kind of see how this loss development triangle would come to where our loss development factor for 18 months, it would be 1.62 on average. So this is the average. The 1.62 is an average of all this. 1.22 is an average of these right here, and so forth and so on. You can kind of see how we come up with each of these factors for this time period, and then we come up with an ultimate from 18 months to ultimate. If we were to do it, if we were to take to see what the ultimate cost would be during this time period is 2.24. So going back to the previous screen, hopefully this makes sense, 2.24. If I multiply this number right here on average times 2.24, this is the number I'm going to get, or approximately pretty close to that on average. That's where that loss development factor is coming into play. So hopefully that makes sense when you're able to tie those two together. So loss development, okay, I think I answered that question there. All right, it's kind of popped up. We do have a question that came up here. Let me see if Melanie, I'll go and unmute your line. Melanie, can you hear me?
Can you hear me?
Okay, go ahead.
Can you hear me?
Yeah, I can hear you. Go ahead.
Okay. I have a question. I hope it's not too silly. On the looking at the numbers from the 18, 30, 42, those are months, right? And it increases from 63.55 and then goes to 114. do those numbers increase because of loss reserves and adjusted expense reserves? I was trying to figure out why those numbers were increasing.
Yeah, so basically that's actually a good question. I didn't mention it earlier. So on a previous slide, I kind of glossed over what was called IBNR. Let me see if I can find it. So down here on the slide on the screen, so loss development factors is another name for incurred but not reported. And what the idea there is, what happens is maybe they're not necessarily new claims, but the reserves did change, and it's because that sprained, the back injury I had that was just a sprain now requires back surgery. And so that's why you see maybe the claim went from 63,000 to 100. Or another piece of it would be that I was off work for a longer period of time. So now, whereas before they thought I was only going to be out for a week, and now I'm out for 6 months. And so that's what also counts for that loss development. And so as much as the adjusters try to do a good job in the reserves, they can't predict everything. And so actuaries can kind of see the pattern, the payout patterns of loss development, that they know that there's going to be mistakes made. And so even though they see the reserves after 18 months, they can, based upon historical patterns, that's where these loss development factors come in. And I think the other question was, you said 18 to 30. Yes, so what these factors are, when you see on the table, it says 1.58 from 18 to 30. The idea is that's the change from the 63,551 to 100,410. It's just doing this time period, and the next one does this time, 30 to 42, and then 42 to 54, and so on. And then ultimately, on the bottom one on the slide that you see on the screen now, it changes, and you do the multiplying of each of the years to come up with an ultimate loss factor, and that's how those are calculated. So hopefully that made sense for you.
Yes.
Perfect. All right, I'm going to go and put you back on mute there. Okay, and okay. So we'll go ahead and go on to the next item here. So now using this chart here, kind of going back as we've gone through here, now we're looking at, so 2001, it's saying, in this case, we're at, our total incurred is 139,000, and we have a development factor in this case of just, it's 1, which means there's no loss development at this point, because these are the dates, the total date of, or how mature the claim is. So this is a very old claim. It's fully developed basically at this point. If we look at the 18 months, this is, so we have brand new data. Our total incurred is $70,750, and our loss development factor is 2.24. Well, where'd that come from? That comes from right here. We're saying 18 months to ultimate. If we multiply that value, now the 70,750 times 2.24, we expect by the time these claims all close out, we close out this entire year, we're going to come out at 158,480 is what our ultimate loss is going to be for those claims. Okay, so the question is, why do they go from 1 year, 18 to 30 versus 13 to 24? Did they go mid-year to mid-year? So that's going back to, in the beginning, if I was to go from 12 months or 13 to 18, the reason why they usually start at 18 to 30 and then they go 12-month periods after that is because if I start at 13, it's still too immature. They want to give it another 6 months to develop at least a little bit more, because even at 12 months, there might be some claims that were, if we go, let's say we're June 30th is our fiscal year, and we have another claim July 1, well, since I'm closing off on that period, I'm not going to count that claim. And so the idea from an actuarial standpoint, they want to start at 18 months so they can capture some of those claims that may have occurred and capture at least a little bit more of that development period. So that's why you see the 18 versus the 30 and so on after that, rather than just going the 13 to 24. Good question. So this is how we would, essentially calculate the ultimate losses now based upon using this table. Now, the other thing we have to keep in mind as we go through this, now, when we did this before, we said, okay, how much are we spending? So right here we have the 158,480. Now we're going to go to the next screen, and we see 158,480 down here. Now we're multiplying it by 1.44, and you go, well, why are we doing that now? Well, because now we have to account for inflation. So, so a lot of times there'll be an inflation factor that will also have to be multiplied. So by the time we're all said and done, this claims from 2005, our most recent year, that's only 18 months old at this point, we projected what was $70,000 to be 158,480. Well, now with inflation, we multiply 1.44. Ultimately, this is going to be $228,000 by the time we're all said and done. Now, I guess the one thing I'd keep in mind when it shows this is that typically most actuaries, they will combine the inflation factor or the trend factor and the loss development factor together to come up with one number instead of having to do the multiplication twice. But in the book, just keep in mind, the book, they show it as a two-step process. So if the book shows a two-step process, that's the two-step process you want to use when you're doing the calculation. So, and that's what also the questions in the back on the Q&A will show as well. So when we talk about ultimate losses, we have 158,000. Now we do the inflation factor. They don't really say, so 0.44 is pretty high inflation, to be honest with you, on this. And so we come up with 228,000. But again, this inflation factor is assuming over a longer period of time as well. That's going to develop over the next 6 years by the time it closes. What's interesting, if you look at this, you can see now we can compare also apples to apples since we're using development factors. Here's what we project the claim is going to cost in, essentially 66 months, and here's what it is in 66 months. So 230,000, we can kind of see we're actually doing better than what we did 5 years ago, even with inflation, which is a good element to show that we're doing a better job, and that's why using these type of numbers and doing loss development is so key as we move forward in our programs here. So now, what's different on this slide? You see, I have inflation highlighted again, but now I'm doing something different. And the difference here compared to the previous slide is before we were talking about losses, and now we're talking about sales. Now this is when we talk about exposure data. So typically for most retail organizations, they're going to base their experience based upon the number of sales. The idea being that the number of claims, the number of people shopping in the store, they can use the actual sales numbers as a predictor of how many claims they're going to have, whether it be slip and falls, those type of things. Might be a predictor in some cases of what type of claims they're going to see in the future. So in this case, what they're basically saying is we did 47 million in sales. You see the extra zeros there in 2001, and now we're at 64 million in sales. There's going to be a trend factor, again, for inflation that we're going to add in this case, and as a multiplier. And we come up with our adjusted sales now using inflation. You can kind of see with inflation, they all come around $75,000, so that's a little bit better average. The projected sales that they put in here for exposure for 2007 is $75,000, which kind of stays in line. So this is the present value of what they're expecting in this next year, and this helps basically determine that. Again, you're not going to most likely have to, calculate, and I'm going to say most likely you're not going to have to calculate. They're going to give you the sales numbers, and you may have to do some projections and using it to say what does this mean, or how many injuries or claims would they see based upon having the sales of a certain amount if they have this type of factor in place. So now we're on to step 4, which is how to forecast the losses. So basically the idea here is if we know that in these various years we had total losses of $230,000 and it's already adjusted for inflation, and we have sales of $75,000 adjusted for inflation, we basically go in and we divide, was it the 75, the 230 divided by the 75, 399, and we come up with losses of $3.06 for every $1,000 in sales is what those losses are. And that's essentially what we're doing on each one of these. Now, the reason why on this one, just so you know, we're not putting the 0 zeros on there is because they've already, by doing it this way, we've accounted for the 75 million in sales. We've already taken off the zeros. They kind of make it a little more confusing by doing it this way, but essentially if you were to take the calculator, do the math, you'll see how they come up with these numbers. And we come up with an average over these last 5 years of $3.26 for every $1,000 in sales. So the idea being that in 2007, if we're going to do $75,000 in sales, we multiply that by 3.26, and that's going to give us an estimate of how many losses we can expect for that, or how much we should project of what type of losses we're going to have in 2007 based upon our expected sales numbers. If we have more sales, we would expect to have more losses. If we have less sales, we'll expect to have a little bit less losses. But this kind of gives you an idea of how using these factors can basically, from a regression standpoint, help us project in the future what type of losses we're going to have down the road. So here's the example that's given in the book of calculating the expected losses. And so Target projects its sales for year 2007 to be 75 million or 75,000 units of sales at 1,000 each. And basically we'll show the exhibit, how Target's risk management professionals calculate its average losses to be 3.26, which is what we did on the previous slide there. So if the sales totaled 75 million, then the expected losses are $245,000. So how do we get that? It's at 3.26 times 75 million or 75,000 units or 75 million in sales, which basically equals at $245,000. That's what we can expect in losses. So then that projected loss figure is for losses limited to $50,000 and only applies to that layer. And you'll see what that means here in a moment of that, because if we had $1 million losses, if you remember prior in some of the other screens, but at this point, based upon our sales, if we had a self-insured retention of $50,000, we can expect that we're probably going to have to reserve or have money be ready to pay for 245,000 claims. That's what our expected claims are going to be for the next year with 75 million in sales. So that's kind of the basis in a nutshell. So now we have to go to some of the next steps, which now we're going to talk about what's an increased limit factor. And basically all an increased limit factor is now we're looking at, well, what if we raised our self-insured retention? What if we went up to $100,000 deductible or $1 million? And that's all that we're doing when we talk about increased limit factors, is we're going to do what-if scenarios using the same methods we used before and be able to project what we think what our future losses would be if we did some increased limit factors. And so an increased limit factor, as it defines here, a factor applied to the rates for basic limits to arrive at an appropriate rate for higher limits. Okay, we said we're going to go up to 50,000. Now we're going to have a factor we'll use as a multiplier to determine, going up the higher limit. It's a three-step process. So develop increased limit factors. We're going to have to come up with the numbers. Those will be provided. It's not something you're going to have to calculate. It's calculated the increased limit factor for a specific layer of loss, and you'll see this on the table on the next slide. And then basically we'll be able to forecast at different loss limits. And so the idea in doing the forecast is by using these loss limits, we can decide, do we want to go from 50,000 deductible to 100 to 250 or to $1 million? And again, as we go through these next slides, you'll see how that basically plays out here. So this first step is we want to develop increased limit factors. So they're developed from aggregate insured data. This is already provided. Individual insurers may not have sufficient claims and high limit layers to make conclusive forecasts. So basically, this is a caveat that they gave in the book, is if you're looking for high limit layers, like $5 million, they may not have very many claims that pierce that level, and so they're not going to have very good data to be able to give you a limit factor. But in general, the insurance company will have some type of limit factor, or the actuaries will be able to determine this, what those limit factors might be. So when we look at this, we can see a loss limit. So this is our base limit is $25,000, and the limit factor is 1. So it's basically multiplied by 1. That makes it easy. 50,000 is 1.2. 100,000 is 1.55. Now, what I tried to do is put a little box here to make it simple, and I'll help explain how this works because it was confusing to me the first time I tried to do this way back when. So assuming we have a $25,000 limit and we want to go to a $100,000 limit or self-insured retention, we would have a factor of 1.55. So we're going to go from 25,000 to 100,000 here. So all we would do, and let's say that coverage for this $25,000 limit was $5,000. All we would do is multiply 1.55 times 5,000, and we come up with, excuse me, $7,750. Now, of course, it's unrealistic to have a $5,000 premium, but that's what I used for this example here in this case. Now, the reason why, and you'll see on this next slide, what we're basically doing is taking, it's going to be 1.55 divided by 1. When I go on the next slide, you'll see that if we were already at a $50,000 level, we would actually divide 1.55 divided by 1.2. So you'll see how this works on this next slide here. So basically, here's our same graph that we have at the bottom. Now we're going to do the next step, is calculating the increased limit factor for a specific layer of losses. In this case, we're going to go from 50 million to 1 million. So we're going to go from 50 million, which is 1.2, to 1 million, which is 2.5. So in order to do this, what we actually have to do is divide 2.5, which is our 1 million layer, divided by 1.2, which comes up with a limit factor of 2.08. Okay, so now the reason why we don't do it, just divide it, we don't still say it's 2.5. If we were at 25,000 and we're going from 25,000 to a million, then it would be 2.5 divided by 1, which would be 2.5. So hopefully I'm not confusing people here. But in this case, we're going from 50,000 to 1 million. So we go 2.5 divided by 1.2, 2.5 divided by 1.2 equals 2.08. And so that becomes the factor that we're going to now look at, what we're going to do as a multiplier to determine what our losses might be. So how does this work out? So if you remember our past losses, we said $70 million or $75 million in sales. We come with $245,000 in expected losses. That's what our projection is under the $50 million limit, or excuse me, $50,000 limit. Well, all we do now is we take 2.08 times 2.45, and we come up with $510,000. So if you did this, if you take a calculator, so for those after the fact listening on the recording, if you take a calculator, 2.08 times 245,000 is going to come up with 509,060 or something like that. So if you round it, it's $510,000. What that basically means is that if we were to go, and it explains it down here, if we were to go to $1 million limit, we can expect our total losses during that 1 year with $75 million in sales, we can expect losses of about $510,000. That's our expected level that we would pay. So based upon the result of the 3 steps down here, the average general liability losses are expected to be $245,000 for losses in this layer, the 0 to 50,000, and its range, and $265,000 for losses in the 50. So in this range from 50 to 1 million. You're going, well, where did the 265 come from? Well, when we did the calculation, we do 510 minus the 245. And so if you add those, this layer, so this layer, which they don't really show here, this layer plus this middle layer is 265, which equals the 510. So the total losses in the 0 to 1 million range are expected to average $510,000. Now keep in mind, this is, actuaries, they predict. This is their best guess. It could be much lower or it could be much higher. But on average, this is what we would expect is probably around $510,000 losses based upon those kind of sales.
Let me know, okay? 909-553-6533.
Looks like, okay. Looks like a background noise. I went ahead and took that off. All right, so we got the other audio issue taken care of. Okay, thank you for that. I must have not unmuted the line there. Sorry about that. So, so hopefully that's fairly clear. It's one of those things where it's just going to take practice, and with the Q&A that you're going to have as kind of the homework area, you'll be able to practice this as part of that. We do have, looks like, another question. No, Melanie, I forgot to mute your line. Sorry about that. So on the, so after we do this one step, so now we forecasted the 510. So step 2, we want to forecast the losses. So if Tartan can comfortably afford to retain losses up to 510, it may consider a $1 million deductible. Alternatively, the company should assess whether the premium charged by its insurer for $1 million in coverage is reasonable when considering the total average expected losses of $510,000. So what does this mean when we talk about this? Is that basically, if you take a look at this, this really comes down to what risk management and risk finance is all about. If we project our loss to be $510,000 and we have an insurance company that wants to sell us a policy that's going to cost us $2 million for the policy to cover us, is that a good deal? Well, probably not. So, you have to look at what the premium is, and so you make that calculation of, well, if we're going to pay for the 510,000 losses, we can probably self-insure up to that $1 million. But the determining factor is, what's the market? Is it a hard or soft market? What is the premium going to be charged? If it's a soft market and I can get let's say I can get that coverage, 510,000, or I can get up to $1 million of coverage, let's say for $750,000. Okay, so basically what that means is that I would have insurance up to $1 million for each individual claim, or the total amount in aggregate, and I pay $750, and yes, I might be overpaying, but now does it allow me to sleep at night? And this kind of goes into risk appetite and risk tolerance type of issues. So if it was $1 million for that coverage, would it be a good deal? Maybe. So that's really what we're looking at when we start looking at what can we afford. Or maybe I want to stay, maybe it's not $1 million, maybe I want to do $500,000 worth of coverage, and what those limits are. And you'll kind of see what those look like here as we go through a couple more slides. You'll kind of get a better idea of what that might be. So this is one of the things of applying your knowledge that's in the back. So the management department wants to know the average expected general liability losses in the $50,000 to $100,000 layer. So we just did to the million. Now we're going to do $100,000. What should the risk management professional tell them? So the increased limit factor from 50,000 to 100,000 can be calculated from the data in the general liability increased limit factor table, which we saw before. And so when we look at this, so in the 50 to 100,000, I'm going to go back a couple slides just so you can see where this is coming from. So 50 to 100,000, so we go 50 to 100,000. It's going to be 1.55 divided by 1.2, and we come up with 1.29. So what we do is we already know our 0 to 50 is 245,000, so we're going to multiply it by that limit factor of 1.29, and so now we know the limit factor from 50 to 100 is $316,000 in that layer. So from 0 to 50,000 is 245, and then if we go all the way up to essentially 0 to 100,000, now we're looking at $316,000 for that. But then remember, we have to do the step. We have to subtract the 316 from the 245, and so within that layer, the 50 to 100,000 is $71,000. Okay, so these are the steps you basically take. So on the exam, you can expect you're going to get this information. They're probably going to provide it. You're going to have to do limited calculations. It's not having memorized formulas, but you're going to have to. They're going to give you all the information. You're going to have to remember the steps and be able to do this type of thing. And again, the idea here is, do you understand where does the $71,000 come? What they might say, if anything, you'll have a question. They'll provide you the numbers, and they'll say, what's the limit from 50 to 100,000? If you put 316, you're going to get it wrong because that's going to be the 71,000 that's in that $150,000 to $100,000 layer, and that would probably be a typical question you might get on the exam as part of that. So now that we've just several more slides here, we'll go through. So when we talked about part one, the hazard loss volatility, we looked at these things. Helped us when we did all these numbers, the 510, the 245, those are expected losses, which means we have essentially 50% chance of getting it right, that we'll have enough money. So expected is exactly that. It's the average, which means there's variation. And now we're going to talk a little bit about standard deviation and what that means. And this is where the volatility comes in, of understanding. We talked about the dollar losses you have, but we haven't talked about the number of claims that make up those type of losses. So that's what we're going to look at now, is how many claims of what types or what ranges make up that amount. Now, the variation, as I indicate, lets us sleep at night. If we know that most of these claims are relatively small, that add up to a certain amount, that's one thing, or do we have a lot of big claims? And that's what we're going to be able to determine in these next several steps. Now, when we do this, we're basically going to do the same kind of pattern, or same pattern in this for three types of probability distributions. So first, we're going to take a look at a frequency probability distribution, then a severity probability distribution, and then we're going to combine the two to come up with what's called a total loss probability distribution. If you look at an actuarial report, they basically do this. This is all the 100 pages that's behind the main part of the report. You're going to see these type of distribution tables back there that they're doing exactly what we're talking about here this evening. So When we talk about frequency probability distribution, losses are evaluated in this case, as it explains, as of 6/30/06. So now here's their past 5 years, and now we want to evaluate as of as of 6/30/06. Excuse me, is the date that are valued as of date, I should say. So as our valued as of date, we've had 5, 7, 6. Now what it indicates in here, it says based upon past patterns of claim reporting, Target can assume 2 more claims will be reported for each of 04 and 05. So they're going to say 2 more claims, so this is going to be 6 and 6. Now why did they do that? Well, it's because of loss development, or IBNR. We can know from incurred but not reported that typically we're going to have 2 more claims that are going to be added to it. And so that's if they give that an example, they'll provide that in the table, but this is what's basically happening. So the idea is, instead of 26, we actually have 28 claims because it's 6 and 6 down here. Now, what does that look like if we were to do a histogram type of distribution? Well, we've had how many claims, frequency of claims or in 1 year, excuse me, how many years do we have 5 claims? We had 1 year that had it. How many claims had 6 claims? We had 3. So 1 claim with 5, and 6, 6, and 6, there's 3 years. So now you can kind of see where this data comes from. So if we're to say what the probability of these events are, using the total, we have a 20% probability of only having a year with 5 claims. We have a 60% probability of having 6 claims a year, and then 20% of having 7. Now, again, that's based upon the data that we have. Most actuaries wouldn't use this data. It's too limited. There's not enough claims to really make an evaluation, but for the purposes of this book, that's what they've done. To show in a histogram, you can kind of see 5, here's 60%, and they're just basically, all they're doing is showing different ways of how this looks. And if you calculate the expected value, which we did in the previous course, 0.2 times 5 is 1, 60 times 6 is 3.6, and then we get our mean frequency of 6.0. Either way, we come up with our mean, our average in this case, our expected value is 6. That's basically what they're trying to demonstrate in these several graphs here. Excuse me. So if we're to do a curve over this, we can kind of see this is what our distribution curve would look like. And one thing to keep in mind here is it shows the possibility you can have 10 or 15 claims. Most likely this is our 1 standard deviation, this is 2, so the likelihood of having 10 claims in 1 year is probably pretty limited in most cases, but so that's why this kind of shows what this might look like, where you might have future claims on there. Now to say, okay, well, what were the dollar costs of these claims? So the severity range, what we're looking at, is of these 26 claims that we've had, we're going to say, so now I'm jumping ship on you here, sorry. So this is frequency. That's the numbers for frequency. We come up with the expected of 6. Now we're going to look at severity probability distribution. Now severity, by its nature, involves dollars. So now we're looking at the dollar cost and how many claims we've had in different range buckets. And you can set up these ranges however you feel appropriate. But typically, in this case, they're gonna provide these type of ranges for you. So in this case, the severity range, we've had 6 claims that had between 10,000 and 29,000. Another 6 between 30,000 and essentially 45 almost, and 5 between 45. And we've had 9 claims that are $50,000 and more. When we look at the probabilities, if we do the multipliers of this, you can kind of see of the probability distribution, 35% chance to have a claim over 50,000. What this also means, we have a 65% chance that we're going to have a claim that's less than 50,000. So even though it's broken up in these buckets, this is what this is basically trying to show, is what does this look like. When you take the exam, I strongly recommend that you draw pictures to kind of put it in your mind of what this would look like. That usually helps most people be able to answer the questions, because a lot of times if it's a word problem, if it doesn't make sense, drawing a picture will certainly be able to help you answer those questions. Excuse me. So now what we've done, we're basically going to do the same thing we did with the prior. We're going to take our mean severity. So you're probably going, well, where did this $20,000 come from? Well, what's the mean between 20,000 and essentially 30,000? Well, it's 20,000. What's the mean? So if you do between 30 and 45, what's the middle? It's 3750 or 37,500. That's where these mean severity came from. We're going to take our probability distribution from the prior page, so 0.23, 0.23, when we do that. And so what you can see here is 0.23 times our mean severity. We come up with 4,600, and you can go through and we add them all up. What this basically is saying is that on average, any given year, we can expect losses of about 39,750 is most likely where most of the average claim, each claim on average is going to equal during that time period around there when we add up the probabilities of all those as part of that. Okay, so one of the questions was, it's been a long time since calculus or statistics. How did they get that curve from the histogram? In this case, all they're doing, they're overlaying. It's not a specific curve. What they're basically trying to show, and part of the challenge, what probably why it doesn't make sense of why I think you're asking the question, is you're seeing down here this is going down, but yet the histogram shows it going up. And the reason why is we capped the claims at 50,000, and so this is taking, this histogram right here is taking everything all the way to this side, so this line actually goes down. The curve on this doesn't really matter as much. They're just trying to demonstrate how, kind of more of how the distribution would work in this type of case. But so I wouldn't necessarily pay close attention to the distribution curve, at least on this one. It's more just to kind of give an impression to show how standard. When we go to the next couple slides, you'll see why they want to show the distribution curve in there. So now we've calculated the severity probability, 39,750, and it's capped. Okay, so the question is how do we get the mean severity numbers? All right, so the mean severity, where did we get this number? The 20,000 comes from, if you take 10,000 and 30,000, what's in the middle? Basically, or you take 10,000 and 30,000, if you whatever, divide it in half. So what's the half of that? Basically, that's how you're getting the numbers, and you can kind of see. Now, the reason why this is 50,000 and it's not half is because we capped, the claims can't go above that. They're capped at 50,000, and so that's why that stays at the 50,000, and we're not doing any division on that. All right, good questions. So let's go on the next here. So now we're going to do total loss probability. So now we're actually going to combine what's our frequency probability distribution with our severity probability distribution to come up with what's called a total loss probability. So now what we're going to do is multiplying the mean of the frequency, which was 6, by the mean of the severity distribution, which is 39,000. So 6 times the severity of 360 equals 239,000. Now, if you think about that, if you remember when we came up with our estimate before, what type of claims, we came up with 245,000 using our example based upon $75,000 in sales. So this is just another method to forecast what our expected losses are. And you'll see how now we're going to use this as a volatility, but it comes pretty close, and that's why actuaries use different methods, and then they use the one that really kind of centers around what would be expected in there. Okay, and where did the 6 come? Okay, so the 6, so I guess I'll go back here. So that's the frequency distribution. So if we go back to this slide, this is our mean frequency is 6. So that's where so our frequency probability distribution, we calculate that first. Then we calculated our severity probability distribution, which is 39,750. And then basically, so it's 6 times that. So that's why I was talking about, you take your frequency distribution we did first, your severity, and then by multiplying comes up with your total distribution right there. Okay, now, why is this important? Why, and this kind of goes back to why did they show the distribution curve in the very beginning? So if you look at this, if you remember, one standard deviation is 68 point something, I can't remember, but basically they kind of show the probability interval 70%. So if you round it up 70%, our expected value in this case is going to be right in the middle. But our range on this is that we can expect 70% of the time we're going to have claims between 227 and up to 261 is what we probably would expect to see those type of claims. And so this, to be honest, we usually don't care about this side. What we're really concerned about, what's the upper limit? And that's really what actuaries are calculating, is what is the upper limit? And you'll see how this plays out on the next couple of problems here. So probability intervals. So just like you have one standard deviation, two standard deviations, you're going to see, what you'll hear about most likely is you're going to have what's called a confidence level. So typically, like for workers' comp for the university, I think we have a 75% confidence level. What that basically means is that if our expected value is, let's say, $510,000, and that's 50%, we're going to multiply that times 1.75 to come up with what the 75% confidence level will be. In other words, that's going to help us determine that gives us more leeway. If we want to be doubly sure, 100% sure that we'll almost never have a claim that's going to pierce that level, we can go up to 100% and over-collect that amount of money. And you'll see how this works out in the next couple slides. So to determine the extent to which actual losses are likely to vary from the long-term average total losses, actuaries use the total loss probability distribution to calculate probability intervals. That's where, again, that's where the table comes into place, or excuse me, the distribution curve. And it's a representation that shows the probability of outcomes falling within certain ranges of probability distribution. And it's determined, intervals determined by the area underneath the probability distribution. That comes back to one standard deviation 70, and you can kind of, now you understand where that's coming from. So in the example, they assume Tartan's total losses will fall between 227 and 261,000 in 7 out of 10 years. The 7 years will constitute a 70% probability interval, or a lot of times we use confidence level. So basically what they're saying is 70% of the time the claims are going to fall in here. Now, there's going to be several years in there, and this is what I was talking about. We don't care if the other 20% of the time they fall here, because that's a good thing. But we're concerned about is maybe the other 10% that they may fall on this side, and that's what we're really concerned about. Let's say this is 15% here and 15% here. So that's where we start calculating under other confidence levels here in a moment. So why do we care about this? Part of this is we have to be concerned about our confidence levels is what's the loss payout patterns. So here, what this is basically showing for this type of payout pattern, I'm not sure what it's not a work comp claim most likely, but they're essentially saying in the first year you're going to pay 25% of the claim, then the next year 25%, then 20%, 20%, and then usually by 5 years you pretty much paid it all off. So you're only paying 10% in your last year. Same thing here. In this case, this is more of another type of loss payout pattern. So the paid losses up to 50,000. It's only 18 months old. We're going to pay 13%. By the time we're 66 months into it, we're about 88% of the claim is paid. And this is based upon historical information. And the reason why this is important is to know, depending on what the interest rate is, of how much money do you have to keep in reserve to make sure you have cash on hand to basically pay for those claims. I wouldn't expect much specifically on this type of question, but this kind of is the background of why this is important. So here's another chart that shows the payout patterns. Essentially, that cumulative percentage paid the first year. So at 12 months, in this case, they are showing 12, and it goes 6 months increments. And what I'll demonstrate here is, if you look, 18 is 13. So 18 months, 13, 30 is 27, and this is where these tables relate. So 30 is 27, and it just adds the additional 6 months in there. The idea is at 12 months, we're going to pay 9%, 18, 13, 20, and you can go through. After 66 months, we expect to pay the full value, 100%, or $245,000. Well, where's that $245,000? Sounds familiar? That's what we expect to pay out during that whole time period. That's what our payout schedule is for all claims, basically in there. So that gives you a kind of an idea of how, even though we know it's going to be $245,000, how much money do we need to collect now and what interest rate, and that's where this all becomes really more important. So if you do dollar amounts, what does this mean? Is that, and this is a little different here, it shows a present value factor at 12%. Now, I don't think we've ever seen 12% interest rates in a really, really long time, and I don't know how long until we ever will. Most of the time, actuaries are using probably about between 3 and 5% now, but for the sake of the book, we'll assume a 12% present value factor. What this is basically saying here is that we need to pay out $22,000 the first year. The present value of that dollar is for 2007. We need to, in actuality, we need to collect $20,000 now is what we're going to pay. This is the total net present value. So in order to pay $245,000 over this period of time, if you add all these together, it's $245,000. We need to put $169,000 in the bank now, earning 12% interest to pay the claims over that period of time. So this kind of goes back to understanding net present value is and understanding payout schedules. If we understand if we don't need to put $245,000 in the bank today to pay for the claims 7 years, we need to put $169,000 in the bank, and hopefully it'll earn interest based upon that payout schedule. It'll pay for claims down the road. So I'm sure that generated quite a few questions there. So this is all these numbers, the 0.943, 0.842. This is from ARM 54 on net present value. These are net present value tables of a dollar, what a dollar's worth, and what you'd multiply 49,000 times this, and this is what you're going to get. So that's where those numbers are coming from. We're going to talk about that. And so now, only two more slides here. So now, using the information provided loss forecast, we can use that information generated by the loss forecast, both to plan for the future and evaluate what has occurred in the past. So by doing this, by looking at our past losses, now we can budget for retained losses. Now we've determined to pay for those retained losses, the $245,000, we need to set aside $168,000, $169,000, earning 12% interest. So that's where the budget aspect comes in. We've also been able to do, by doing these analysis, we can evaluate alternative retention levels. We can make a determination of whether we should go to a $500,000 self-insured retention or $1 million. But that's going to be predicated on what the marketplace is insurance rates hard or soft, what income we have from the revenue. So those have to be part of the consideration. It's not just, hey, we can retain those. We have to determine, whether insurance, transferring risk or buying the lower deductible coverage makes sense for us. And also, and that's the next piece that helps us evaluate the insurance premium charges. Based upon insurance premium, we can say, we want to go with a higher deductible and have them do that. And then also it helps us update accounting reserves for retained losses that occurred in the past. And so we can determine whether our how claims are developing, and that's what actuaries do, is they take every year and they'll reevaluate those to make sure that we're on track, or do we have to collect more money, or can we give money back as a rebate? So here's the example, the final example that's given in the book of what this might look like, policy limit projections. So in this case, what it's saying is if we had a policy limit, in this case, of $1 million, total losses subject to a limit of $1 million. So at 50%, we expect at expected level about between 498,000 and 529 losses. That's what's expected. You're going, well, where did the 510 go? Well, if you take this number and divide it in half essentially between the two, 510 is right in the middle. That's your expected value. But again, there's a little bit of a range there. At the 70% confidence level, our upper limit is 540,000, and at 90%, it's 554,000 on this upper limit, based upon the standard deviations there of what's expected in those claims. Now, if we do a this one showing retained losses under $50,000 deductible, so this is the 0 to 50,000. We know at 50, our average expected is 245. That 245 sits right in between there. So the 50% range would be between the 232, 256, 70%, and so on. And then our last one looks at our total insured losses in layer from 50,000 to 1 million. And so what this is basically saying, again, 264 is right in the middle, and that's our expected. So if we were to buy insurance and or if we're looking at it, this is what we expect. And the last one is kind of interesting. Our upper limit is 610,000 in this case of what, based upon how the calculation's done. Now, you're not going to again have to calculate necessarily this, but you're probably going to get a table saying which one's the best deal, what would be the best alternative in considering this, or they'll give an example or scenario and say what would you recommend, which insurance deductible might you recommend if insurance cost X amount of dollars or those type of things. And so the idea being, can you apply this information to kind of make a good business decision on what's the best way to go, or how would you recommend that to someone moving forward? So the question is, in practice, would you normally have your broker do this analysis, or is that a conflict because they benefit from higher deductibles? What kind of insurance consultant would do these calculations if you didn't have the resources? So the reality is that actuaries would do these calculations for you typically. A broker, actually, in most cases, brokers, they make their money regardless of what, from a policy standpoint, whether it's a fee for service. They typically, especially in public entities, they can't do it as a percentage. So the fact that, hey, they want to sell you a policy that's more expensive is not something in the public sector they can do anymore, per se. So usually it's a flat fee, and then they would help do this analysis. And again, typically, by the time you're doing this type of analysis, your organization is probably of such size, you're going to probably do self-insuring to a certain extent. And so most likely you can hire an actuary. And that's actually somewhat of a plug for Bickmore, who is my former employer, who has a bunch of actuaries. That's basically what they do, is they'll do feasibility study for private as an independent organization outside of a brokerage. So for those that feel there might be a conflict of interest, they would basically do these, as well as any other actuary can do the same thing. But the reality is that most organizations are not going to do any of these calculations we talked about in the chapter. And I would say that from the institutes, they're not expecting you to do the calculations, but what they do expect you to do is be able to understand how an actuary does get their numbers. That's really what this chapter is all about. Be able to explain how the actuary gets their numbers, the methods that are used, and that's really the key to this chapter, and be able to understand it, and be able to really understand risk finance. And that's why this chapter is really fundamental to understanding risk finance, because it's the basis on which you decide whether you're going to be self-insured, you're going to do a high deductible, a captive. All those other types of programs are going to be predicated based upon this analysis that's going to be done to determine how much are you going to retain as part of your risk. So a lot of information tonight. I strongly encourage you to do the questions as part of the Q&A. That'll certainly help you out, and I strongly feel free to email me or call me afterwards if there's some questions on that. So before we do, there's a question that says on page 2.17, how do you determine the forecasted losses, and how did they get the $245,000 for the $50,000 limit? Unfortunately, because I'm out of the office in a hotel and I didn't bring my book with me, I'll have to double check on that one, Melanie, and I'll get back to you on that, and then I'll see about sending an email out on that. So again, I hope everyone has a great evening, and next week we will be covering Chapter 3, and we'll go from there. So thanks again, and everyone have a great evening. Thank you very much.